All right, everybody. Well, welcome to the weekly update for January 12th. And today we're just going to discuss the projections for 2024. Now, as I upload this slideshow, you're going to see that this was produced by MBS Highway, which is a service that I use to stay on top of stuff. So just wanted to go over some encouraging news that I read and wanted everybody to kind of have an idea of where we're headed for this year and the next few years. So let's go ahead and jump right into it. So the first slide that is here is core inflation. And the most important thing to know right here is that core inflation has gone down. Now, why exactly does that matter if we're talking about mortgage rates? Well, the Fed, who governs the Fed funds rate, and this will indirectly affect mortgages, has stated that they want to see inflation to get down to 2%. While we're not there yet, we are definitely headed in the right direction. And as you can see, if these inflation numbers are going down, that's what they want to see. Now, the second slide here is talking about shelter for the inflation numbers. Sorry, I just blinked out. But for the inflation numbers. So if we see at the very start here in December of 2022, the reading was 0.79%. Now, why is this highlighted and what is this showing? Well, each month that we continue to go, this December number will be replaced by December of 23. The January number will be replaced by the January of 24, and then February will be replaced as well. So when that happens, the overall number will drop, which is what the Fed wants to see, and our numbers will get better. And then why does this affect interest rates? Well, it's going to affect it because if we get closer to that 2% in inflation, the Fed should cut their Fed funds rate, which should again indirectly transfer into lower mortgage rates. So as you can see here, these are the estimated numbers for inflation. And then right here, if we look, you'll see December 23, it's an estimate of 0.1, which should replace 0.39. And so what will that do for the core PCE year over year? It should drop it to 2.87. And how do we get that? Well, we take the difference between the monthly estimate of 0.1 with the replacement of 0.39, and that gives us a difference of 0.29, which again, if you subtract that from the 3.6, we now have 2.87. So as we continue to go through this year and these 0.1 estimates are replacing 0.39, 0.51, 0.36, our inflation number should drop from 2.87 to 2.47 to 2.21. And then in March, we should be right almost at 2% at 2.07. So the Fed meetings in January and March, we're anticipating that there could be a cut, but most likely what we should see is January, there's a 7% chance the Fed cuts rates. In March, we're at a 68% chance of the Fed cutting rates. And then in May, we're at a 94% chance that the Fed is going to cut their Fed funds rate. So this is the Fed dot plot, and you'll see this mentioned a lot in news articles. And basically the way you can look at this is each member is going to use their dot and place it where they think as far as what's going to happen for the year of 2024. Now, if you'll see, there's two members that think they're going to cut 0 cuts, one member, 0.25% cut. Then down here, we have 1, 2, 3, 4, 5 for a 50 basis points cut. And then we have 6 for 75 basis points. And then 4 for 100 basis points. And then 1 out here, we have an outlier at 150 basis points. So do you need to know what they're going to do exactly? No, we're trying to look and see where it's trending. And obviously by this red arrow, it's trending down. So we can expect confidently in 2024 that rates are going to drop. Even more encouraging, and as this arrow states, for 25, we expect more rates to be dropped. 26, we expect rates to drop as well. So we're currently at the 5.5 benchmark rate. By the end of 2024, we're supposed to be below 4%, which is obviously super encouraging for interest rates. For me, outside of mortgages and investing in real estate, this trend right here is promising because as rates go down, values should go up. Now, if you're looking to get into real estate, perhaps with your first home purchase, maybe looking to purchase an investment property, 2024 is the year I would want to do it. Now, obviously, that sounds self serving. I am a mortgage company. I make money when people do loans. But as an investor, as in a consumer, I know if I can get in here and the next 2 years rates continue to go down, what is the best educated guess that I can get for my properties that I'm purchasing this year? The values are going to go up. So as an investor, I want values to go up because I'm going to be making money. But as a homeowner, I want them to go up, but after I purchase it. So this year, I think, is a prime year for those of you looking to get in the market to purchase a home. Now, another interesting thing too is this is the Fed balance sheet, meaning the treasuries that they hold. They're maxed out in 2022 at 8.5 trillion. They are now down to 7.1 trillion. So as far as comfort levels for what the Fed is looking at, they're trying to go from a peak balance sheet level of 33% back down to this 21 to 22%. And based off of these projections, that should happen in November of this year. Now, we're going to skip that next slide and then go to the 2024 rate forecast. Not that we don't need to go over that slide, but for the purposes of this video, we're just looking at interest rate forecasts. And the 30-year fixed mortgage rate is projected to be anywhere from the mid fives to the high sixes. I personally think we're going to be in the mid fives to the low sixes. And the most important part of this slide is the under 6% should move should unlock move up buyers. Now, a move up buyer is somebody who currently has a home and they're looking to purchase a bigger home, maybe more land, maybe something else going on. And the reason that this should unlock is there's a lot of buyers who got low twos, high twos as far as their interest rate goes, and they didn't want to move when rates are at the 8%. The anticipation is once rates drop below 6%, that argument will now be out the window. And buyers will be looking to move up buyers will be looking to move up for their home, which is going to unlock a lot of first-time home buyer inventory. Now, the second part of this slide is the 10-year treasury. We anticipating it being anywhere from 3% to 4.4%. And this is very promising, especially when you go down to 3. And then the second portion of this slide is return to more normal spreads could cause mortgage rates to drop even further. Right now, we have a larger than normal spread between the 10-year treasury and mortgage rates. If that goes back to normal levels, rates could drop even further. Now, as far as inventory goes, true to form with those move up buyers and people who are experiencing what's called the lock-in effect, where they're not ready to move, it is anticipated that inventory remains this year, which again is going to increase competition. So this last slide that we're going to go over is the 2024 real estate forecast. We anticipate that nationwide, the appreciation should be anywhere from 4.5% to 5%. And most notably, transaction volume should go up anywhere from 15 to 20%. So what does this mean overall? We anticipate rates going lower. We anticipate that being the trend for the next 2 years. And we anticipate that inventory is tight. So what does this mean for you as a home buyer? 2024 is the year that you're going to want to get into something. And why is that? Not because of emotions, but because of numbers. If you can get into a home this year and rates continue to drop, two things will happen. As rates go down, values should go up, which should create appreciation for you. And then another added bonus, if you get in this year and rates continue to drop, then in a year or two, the house that you can already afford now, you can refinance, making your house more affordable. So now you have a cheaper home payment for a home that you paid a price for in 2024, that by 2025, 2026, should be worth more. Like we said, appreciation 5% each year, 10% appreciation over 2 years on a house, let's say in California, that's averaging around 80 to 9, or I'm sorry, 800 to $900,000. That could be $80 to $90,000 of appreciation. So overall, all of this very promising. As you can tell, this is my Friday update. It's not super produced. It's just raw information that I think is valuable. I would love it if you guys have any questions, please put them in the comments. If you want to reach out to direct, can. And please also share this with people that are looking to buy homes this year. I think it's very valuable information. If they have any questions, they can also reach out to me, and I'll see you guys next Friday.